Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. And so we haven't done one of these episodes in a little while after a nice spat of, really senior level guests. And so wanted to kind of dive in some of the stuff that's been happening over the last few weeks, and in particular this last week, which I think you can classify as a no good, very bad week for the world of corporate direct lending. And I think to start there, I think with the current news cycle we're in, which is obviously a negative one for a number of reasons, but one being the term private credit, and I think there's clearly been some conflation with what the term used to mean just a few years back and what it means today. And I still think, in general, when you see articles in either Bloomberg or the Wall Street Journal or the Times or elsewhere, that when they reference private credit, everyone, I guess, has a sense of what they're talking about, which is really the corporate direct lending space. But I think it's needs to be made a bit clearer, given the depth and diversity that private credit has today, and so it has certainly evolved a great deal from where it initiated from, and I think that's played into maybe some conflation, either within these articles or by some in the market net worth, what is being referred to as the retail investor, but really the high net worth, wealth client. When they think of private credit, it's being conflated, I think, more by them, given the lack of depth in some of these markets, which is obvious. They have day jobs, and this is to help with a nest egg or retirement. But I think it, certainly has made for some confusion. I mean, the term private credit today, I think, is really a catch-all term for a lot of different strategies. And those in the market obviously know that. Not all allocators, I would say, know that. They're getting more sophisticated on it. For sure. I mean, we just hosted a direct lending conference in London a few weeks back, this past week, which is where I was at our European conference. And still the term private credit is thrown around in a lot of different ways, and certainly was a topic of conversation at both conferences, in particular, obviously, the European Direct Lending Conference, given that's where the term has evolved from, which is the corporate direct lending space. And so I think when thinking about private credit today and the jitters or the worries in the market, it's really concentrated, I think, mostly on the direct lending space. And this week you saw, since the start of the year, some of the biggest brand names, the Ares, the Blackstones, the Blue Owls of the world, all are listed publicly traded companies, are down between 30, 40%. And the other, element to some of this is just the increased redemption requests at a lot of firms, and some, have had to cap, redemption requests, and that's, kind of a twofold reason there. There is a regulatory issue to it when it gets to a certain number, but also it's a protection measure. And those investing in the fund know that when investing in the fund to begin with, does everyone, excuse me, know that when they're investing in the fund at the beginning, maybe not, but ultimately it's there to protect investors that want to stick with the product or the asset class. And so, I think the numbers that we've seen have certainly been eye popping. Some have reached 14, 15%, but most firms have capped it somewhere between 5 and roughly 8%. And that's a means to give that periodic liquidity, but also as a means to protect investors that want to stay in. And so I think it's made for big headlines. Hey, this firm has gotten 14% redemptions. This firm is 9 or 10 or 12, and they're capping it, not letting all investors get liquidity. But it has a purpose to it. There is a regulatory angle, which I'm not sophisticated enough to go into in terms of a regulatory piece. I'm not a regulatory lawyer, but it certainly is there to protect those that are still wanting to stay in the fund long term, because ultimately these assets, privately held assets, the ethos of them is you give up some liquidity for a higher return, but you're waiting on that return at some point in the future. And so there is a trade-off there. And I think some of these vehicles that have allowed high net worth clients to come in who are looking for a bit more liquidity than, say, your institution investing some of these assets. I think a lot of this really comes down to an education gap. And where does that education gap land? Does it land with the fund? Does it land with the IRA? Does it land with, the advisor that's advising ultimately those putting this money in? I think there's probably some blame to go around across. But ultimately, there is also some blame on the investor that should know and better understand where some of their money is going. And I also think there's a fair amount to be put on the advisor or RIA community, to really let them know that this is an asset class or an asset that you're investing in. That's not a stock. And if it's not a stock, then liquidity is not equal to that of a stock. And, you need to understand that. And ultimately, it does pay out in the long run is the hope that you're giving some of that liquidity up, but you're getting a higher return at some point in the future. So I think what it really comes down to, and we do have an episode coming up, I think it's going to be next week, with one of the big names in this market, that's going to talk about some of what I'll talk about today. We'll obviously go more in depth on the episode and what it means, especially for the retail or high net worth client. But really, is where are we today? Is it a battle of headlines versus fundamentals? And, ultimately, where are the pockets? Because I do think there are pockets within the market today that are clearly stressed and that are feeling that stress. Some of that is unknown stress, given where the impact of AI is on technology and other firms that ultimately the private credit funds are lending to. There's been the term SaaSpocalypse thrown around. There's been a lot made of, all right, jobs are going away from AI, or companies that are seeing certain revenue or profit numbers today. Will that last, given the impact of what AI might mean on that technology business? But I think it goes well beyond technology, the impact of AI. What will it mean for a small business on Main Street that maybe can more efficiently put together or more efficiently deliver a product or service? And maybe they need to have, one staff member instead of 3 or 4. Maybe profits go up in that sense, but you also have more people out, looking for new jobs. I think there's this unknown with the technology piece right now that has really started to spook, and even some institutions, in this sense, has started to spook folks in the market of what ultimately is going to be the impact of AI. Will there be a regulatory buffer or something created to minimize or in some ways protect against the impact of AI? I have no idea about that. Who knows what the geniuses in Washington are doing today, especially in this sense of the impact of AI. There's obviously a lot of chatter and noise coming from Washington, as there always is. But what does that impact ultimately be? It's hard to tell. I mean, you saw J.P. Morgan this week say they're going to restrict some lending to private credit firms that are exposed mostly to the technology or software sector, and so that kind of a cascading impact of obviously the fear around the direct lending space that AI is going to impact some of these companies where there's plenty of loan exposure to today. And I think the news of JP Morgan limiting what they're going to lend to private credit firms who ultimately lend out to the small businesses is just another piece of bad news for the direct lending space, which has been obviously hit by bad news since probably October, but really the last few weeks in a pretty significant way. And it's just another story leading with private credit fears. And like I talked about at the top, I think it's more direct lending fears instead of wider private credit fears, because you still have really good performance with sectors like asset-based finance and fund finance, where you just see tons of capital still going to both of those spaces, especially ABF, given the downside protection you see and ultimately the asset at the end of the line. I think that gives a lot of investors comfort of what they're investing in, is sound. And if it's not sound, there's at least something to be recouped, which on the flip side for direct lending, it's not an equal result there if something does go wrong. And then on top of that, you've had these stories about fraud and the cases of First Brands, Tricolor, MFS, and others that have really plagued the news cycle, putting a greater emphasis on, has this come down to underwriting? Has this come down to fundamentally something wrong within the direct lending market? But there's also, good news coming out of the space. You saw ADIA, the Abu Dhabi Investment Authority, investing in an Asian private debt firm. You saw even some of these lenders that have been under pressure lately say returns, I think at Cliffwater 9.4% last year, MSIM well over 8%. And don't quote me on these numbers. I believe I saw some of this in either a Bloomberg or a Wall Street Journal article, but you're still seeing a high quality return for a lot of these assets, even with the negative news cycle that we're currently in. And to be frank, a lot of this negative news cycle, we have no idea, what the impact is going to be 12, 18, 24 months. I mean, we're living in a time period right now that is obviously very finite and short. But, the impact of AI, who knows on loans that were just made or made last year. A lot of the fraud is I think starting to be uncovered, that might be in the space, but when has that fraud started and when's it uncovered? So I still think there's plenty that needs to be, shook out of the market. But one thing's for certain, I think the retail push has really, you know, taken the coverage of this market and amped it up a significant amount. You even heard at a Bloomberg conference this week Cecile Mayer Levy and I'm probably butchering her name because she's French. So I apologize, Cecile. But from Takao Capital, the Bloomberg event this week said, what's been amplified clearly is the acceleration of retailization. There have been many warnings for so many years about the mismatch between assets and liabilities inherent in some of the funds. And so here we are. And I think that goes to, what is the education of the high net worth or retail investor coming into some of these funds? And is there a full understanding of the asset liability match or, as she said there, mismatch? And so I think the ultimately the big thing going on today is one is uncertainty, one is fear. But I think a lot of this comes down to education amongst the these new investors that are looking to park their money in what they've heard is obviously a safe asset, but they're giving up some liquidity for that. But are they fully aware of what liquidity they're giving up and how often? And still think that's plays into a lot of this. Now, some signs that we saw late this week out of Apollo might help to solve some of this. And I don't know how many will follow in the footsteps of one of the biggest funds out there, but there was reported in Bloomberg, Apollo's going to work towards reporting on NAV or the net asset value of its credit funds monthly, with the hopes of moving that to daily at some point in the future to provide some clarity on value. And so will this lead to a push amongst the broader private credit fund space that others follow in their footsteps, and all of a sudden you have the top 10, top 15, top 20. I don't know how if you can go throughout the full long tail, but providing daily updates. We'll see. Let's see if how quickly Apollo can get there first. But back in December, Mark Rowan, CEO of Apollo, was quoted as saying traditional asset managers will not move in size into the private marketplace unless we can do things like daily NAV, unless we could provide price, unless we could provide liquidity. That's going to require the industry to learn a new set of skills. That was back in December, and clearly they're now pushing to start that new set of skills and provide, at least from the article that I read this week, monthly NAV with the hopes of moving to providing daily NAV. And now the operational increase in what that means, I don't know yet, and I don't think anybody does, except for maybe Apollo, who's building out this capability. But how many will follow in their footsteps? I think a lot of that remains to be seen. But one thing you can definitely see, and I could post this chart in the show notes, is if you look at inflows from private wealth to some of the leading private credit managers. Bloomberg had this in I think their Going Private newsletter this week. I was just reading it a little while ago. And the chart, I mean, it just goes straight down. So in August of 2025, you had about 4 billion in inflows from this high net worth retail investor. Jump ahead to February, and now you have 1 billion of inflows. So clearly, the retail investor is wary of this space right now. I don't think that is conflation. I don't think that is something that is just headlines only. They're clearly worried. The question is, are their worries founded, or are their worries because of what the news articles are saying and they're just parking their money elsewhere for the time being? I think we're probably looking at something closer to the latter versus the former, but that remains to be seen, obviously. But clearly a trend that the market is been hit by significantly, especially when about 20% of evergreen funds are now made up of this high net worth or wealth client. And so that's 20% of the total AUM of evergreen funds is now this type of client, and when it drops by 3 billion in less than a year, that's it's about a 75% drop, 4 to 1. So, maybe if my math is correct there, but that's significant. And so I think, private credit managers have now, I saw Ares did a town hall this week. The Apollo News of providing hopefully daily NAV reports. There's clearly pressure, and the funds are starting to react now. They're having more meetings with investors. They're sending out more investor notices. Will ultimately this calm? I think part of the stuff that will calm the market is, obviously meeting redemptions and not scaring people as much redemptions that they can meet with whatever the structure of the fund is. I also think the Iran war subsiding, though it's helped to be a distraction for some, as I think the Goldman there was an article, I think Wall Street Journal quoted a Goldman executive saying it's been a at least a distraction from some of the private credit news lately. But I think that's also played into these fears. You have a lot of bad or negative things going on all at the same time. And so, what does that mean for direct lending? I think it's in a precarious position for the first half of this year. I think it will weather the storm. I don't think structurally banks are going to come back in this market and lend to all these businesses that private credit firms have acquired in terms of customers. And banks are, still playing a major role in this space, providing financing to the funds or, providing, facilities, back leverage and, fund finance and the like. But I don't think structurally you're going to get banks that are underwriting some of these companies like they did pre-GFC. I think similar to the ABF market, where you have a lot of fintech originators now originating the loan, and a lot of their capital still coming from banks. So banks are playing a role in the market, just a different role than they used to. But I do think direct lending is in a tricky spot for at least the first half of the year. If the Iran war wraps up soon, you see a little bit less on the fraud side, though we might see more of that in the coming months. But if you could shake some of that out, some stability comes, and performance ultimately still continues to be strong, I think people will come back. Performance. There was a paper also in the Bloomberg newsletter that they referenced from an investing house that basically said, if you looked at the past 25 years, private assets significantly outperform public assets. And so when thinking about real contagion and what's taking place in this market, I still think we're at a time today where real contagion, I'd say, is still fairly small and unlikely. At least that's also the conversations I've been having with managers and others in the market. But I think people are really, looking at this market and saying, is that where I need to put money today? And that's the tricky thing. And I think you might see some firms that don't last this cycle. There might be some acquisitions, some M&A that happens in the space, but ultimately, I do think direct lending is a safe investment going through a patch, a rough patch for sure. But I think it will ultimately last through. I think seeing firms like Adia, seeing firms like Mubdala, who I think it was late in the year, early this year, had referenced that they're still very much investing in the space, even with some of the jitters that were happening towards the end of the last year. So the institutional money is still very much, coming into this space. Inflows for that are still strong. Are they, on par with last year and the previous year? Probably a bit down. If I had to go look up the numbers, though, we were just at an event this week that said, Europe's has one of its best years ever. So there are other areas. It doesn't have to always be concentrated here in the U.S. Obviously, the U.S. is the biggest market, but there's been positive headlines as well in this market. And so I think you'll continue to see money being invested in this. And, I think what we started at, that conflation of, private credit is no longer just corporate direct lending. There's asset-based finance, there's fund finance, there's other strategies under the more and broader, wider umbrella of private credit today than there ever has been before. Just a couple of notes. We have some real interesting episodes ahead, some playing right into this. So we'll have Stepstone on the show coming up soon, as well as a closer examination of what happened with First Brands, with a diligence firm. Then we have some other executives in the pipeline as well. So some other stuff coming in the coming weeks and months, and we'll have some different formats as well. So get ready for some more fun. Again, thank you for continuing to listen. Please do provide a review, rate us. We really want to hear your feedback. We want you to tell the rest of the community about us. So please spread the word. Thanks for continuing listening, and hopefully we'll see you at some of our upcoming events. So we do have our direct lending conference in mid-April, April 16th and 17th in Nashville. We have our annual CLO conference and CLO awards at the end of April in New York City. And then we have our first ever digital infrastructure conference in June in New York. So just go ahead and head to dealcatalyst.io. You can check out any dates for any conferences. If you're interested in sponsoring, interested in speaking, attending, we have everything there for you on the website. You can go ahead and reach out to me anytime if you'd like. Come on the show, be a guest, sponsor. We have some really great stuff in the pipeline. So thanks as always. And again, thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.